This is question number 4 on the homework 4, homework 2. This is a kind of a comprehensive exam exercise on the calculation of the return on net operating assets and the related calculations. So let's read the setup first. Analysis and interpretation of profitability, balance sheet, and income statements for target corporation follow. And so we're provided with 2 years balance sheet and 3 years income statement. And hint, we need to read this very carefully because later on the calculations may involve this. For sales, use total revenues for your computations when applicable. Compute net operating profit after tax for 2007. Assume that the combined federal and statutory rate is 39%. And we also have to pay attention to the rounding requirement. Round your answer to the nearest whole number. So let me use this Excel to solve this question. So let me just first copy these numbers, copy all the numbers. Just paste special. I think we can use paste text. And so now you see we have this sort of we have copied the income statement basically, and then I can do the same for the balance sheet. Can save me some effort in copying manually. So again, just paste the special and use the text rather than HTML. Otherwise, it's going to be one single row. Every number just in one single row. Okay, so now we have pretty much the information copied. So first, we need to calculate RNOA, return on net operating asset. So in order to do that calculation, we start from, remember, this is defined to be, if we go back to our lecture slides, we can find the net operating return on net operating asset is defined to be net operating profit after tax, NOPAT, divided by average net operating assets. Okay, so first we need to calculate the numerator here, NOPAT, but NOPAT is further equal to net operating profit before tax, which is NOPBT, minus tax on operating profit. And further, the tax on operating profit equals the tax expense plus pre-tax net non-operating expense times statutory tax rate. So this net operating profit before tax pretty much is this this earnings and earnings before interest and the taxes. Okay, so that's my NOPBT. Okay, so that's basically is EBIT. And so we just copy this number here. EBIT is right here. And then after that, we need to get the tax, right? The tax on operating profit. And this further equals the tax rate, tax. This equals the tax expense, which is the provisions for income tax right here, and then plus pre-tax net non-operating expense times statutory tax rate. So this pre-tax net non-operating expense, in this case, is only the net interest expense, because that's the only non-operating expense. Okay, so this equals that, and then times the statutory tax rate, which is provided by the question to be 39% right here. So 39%. All right, so that's the tax. And then we can now calculate NOPAT, right? Net operating profit after tax, which is equal to the difference between the NOPBT or EBIT and the tax here. So that's NOPAT. So we are done with the calculation for the numerator in order to calculate this return on net operating asset. And then we just go to the denominator, okay, the denominator. So we need to calculate NOT, okay, and NOT here we need to, for both years, we need to calculate for both years. Just copy the year number. So then in order to calculate NOT, we need to single out what is the operating asset and what is the non-operating asset, and what is the operating liabilities and what is the non-operating liabilities. So we just go to this table here. This table here tells us which are the operating assets and which are the operating liabilities, and their difference is basically the net operating assets. And then for the, so this is for the balance sheet, and for the income statement, we'll also have the difference between the operating part and the non-operating part, basically. So the operating income is most likely, in most cases, is equal to the EBIT. So that's the this is the operating part, and the non-operating part in our case is only the interest expense, because there's no dividend revenue and this investment gains and gains and losses, right? And the other parts. So this is only the non-operating expense. So in order to do this calculation, we first try to get what is the operating asset. So we start from a current asset. Cash and cash equivalents are not operating assets, so we should exclude that. And credit card receivables, this is like accounts receivable, we should include this as part of the operating assets. And the inventory is operating assets too. And so and other current assets, generally speaking, is also part of the operating assets. And property and equipment, land here is operating asset, and buildings and improvements also is operating asset, and fixture and equipment operating assets, and computer hardware and software as operating assets, and construction in progress is also operating assets, and accumulated depreciation is also operating asset. And so finally, this net basically is the sum of the land, buildings, improvement, fixture and equipment, computer hardware and software, and construction in progress, and the net of this accumulated depreciation that equals this net property and the equipment. So once we have this number, we can just forget about this. We can just use that one single number just to simplify our calculation. And also other non-current assets is part of the operating assets too. So that's the asset part. And for the liabilities part, we have the accounts payable, which is the operating part, and we have the accrued and other current liabilities, operating part, and the current portion of long-term debt, and that's not operating liabilities, so we should not include this. And long-term debt is also not, and this is basically the financing part. And deferred income taxes is operating liabilities, and other non-current liabilities is also operating liabilities. And so that's it. So now we can just calculate net operating assets equal to the sum of the operating assets and then minus the sum of the operating liabilities. So basically we sum up the credit card receivables plus the inventory and plus the other current assets. And then we also should sum this net property and equipment, and also this other non-current assets here. And then subtract. Okay, subtract the sum of the operating liabilities, which is accounts payable and accrued and other current liabilities, and this deferred income taxes, and then the other non-current liabilities. And so that's it. So that's for the 2007, and then we just can click on the cell, and this extends to 2006, and this is the number for net operating assets for 2006. So finally, because RNO's return on net operating asset equals the net operating profit after tax divided by average net operating assets. So we have all the information needed in order to calculate this. So this equals the net operating profit after tax divided by this average of these two numbers, average of that. And then multiply by 2. And then we should change this to be in percentage terms. We can go back to we can further go back to this rounding requirement. Round your answer to the nearest whole dollar. So we actually should first start from NOPAT, which we did, which is right here. Just copy the number here back. And then I don't know whether this comma sign will be accepted. Just yeah, maybe yes, I believe it's actually automatic added, so that will be accepted. And part B, compute net operating assets. I think we can also copy the number here. Copy the number and copy the number for 2006 too, right here. And then to part C, compute targets RNOA, net operating profit margin, and net operating asset turnover for 2007. Do not round until final answer. Round 2 decimal places. Do not use NOPAT times NOAT to calculate RNOM. So RNOM, we just calculated this to be 13.26. And net operating profit margin, NOPM. This equals, if we go back to our lecture slides, this equals the net operating profit after tax divided by total sales, the sales, and then times this is basically the NOPM, the net operating profit margin, and then times the net operating asset turnover. This is defined to be the sales divided by average NOA. So this is the NOPAT divided by, remember this is the total revenue. If we pay attention to the to this hint for sales, use total revenues for your computations when applicable. Okay, so we need to use the total revenue rather than simply the sales. Yes, and that's my NOPM. And again, I want to change this to be percentage terms and keep 2 decimal places according to the rounding requirement here. I believe that's the, yeah, round 2 decimal places. Yes. So just copy the number here, 5.27, and then NONT, that's the net operating asset turnover. So this is defined to be the total sales, total revenue, and then divided by the average NOA, net operating asset, okay, plus this, and then divide times 2. The reason I multiply by 2 rather than divided by 2 is because the denominator should be divided by 2. So I don't want to add another layer of the parentheses, so I just directly multiply 2. This is the same as dividing a denominator, which is divided by 2. That's taking the average of these 2 years NOA. Okay, so that's the, again, I don't want to keep the dollar sign because this is the unitness. So I want to keep the number and keep only 2 decimal places according to the rounding requirement here. So this is 2.52. That's my number here. So compute part D, compute net non-operating obligations. So net non-operating obligations is defined to be the non-operating liabilities minus non-operating assets. So anything which is not marked in red are non-operating asset or non-operating liabilities. So let me just calculate NNO which is NNO, yes, net non-operating obligations. Okay, this 2 years, we also need to calculate this 2 years number. So again, this equals the non-operating liabilities. Okay, so we start from the liabilities part, which is the non-operating liabilities that includes the current portion of the long-term debt and notes payable. So this includes that, and then plus the long-term debt. And I believe that's the only, those are the only two items for the non-operating liabilities. And then we should also subtract the non-operating asset. So non-operating asset here basically is cash and cash equivalents. So it's right here. And let's check whether there's any other asset here. I believe not. So that's the only non-operating asset. So this is the net non-operating obligations. So just pull the cell to the right to the 2006 year, and then we got this number. So just copy the number back. So this is the net non-operating obligations for 2007. Just copy the number back, and then just copy this number back. So now we have part D also completed, and then part E. Part E is compute return on equity for 2007. Round your answers to 2 decimal places. Do not round until your final answer. So for this part, we can just use the definition for ROE, right? ROE is defined to be net earnings divided by average equity, right? Average amount of equity. So total shareholders investment, that's the equity. So we just ROE is defined to be the net income or net earnings right here, and then divided by the average amount of total shareholders investment, okay? And then plus that, and then times 2. So again, I want to keep 2 decimal places and keep this in percentage terms. So this gives me 18.68%. So 18.68%. So find F. Infer the non-operating return component of ROE for 2007. Use answers from above to calculate. Round your answer to 2 decimal places. So in order to answer this question, we just need to understand that ROE, we go back here, ROE equals the operating return plus the non-operating return. So operating return basically is this RNOA, return on net operating asset, which we just calculated. So in order to figure out this non-operating return component of ROE, we just need to subtract this RNOA, which is return on net operating asset, from ROE, and then we're done. Okay, so we have pretty much every number here. So it's return, let me use non-operating return, okay? So this basically equals ROE minus this RNOA. This gives me 5.42%. So just put this number here, 5.42%. And then finally, in this part G, which of the following statements reflects the best inference we can draw from the difference between target ROE and RNOA? So here you can see that all 4 choices say that ROE is greater than RNOA, and that's true, right? Because we just calculated ROE is 18.68%, but RNOA is 13.6%. So ROE is obviously higher. Then we need to understand why ROE is higher, because the difference between ROE and RNOA is basically the non-operating return which is calculated, right? This return basically comes from, if we go back to this table here, we can see that the non-operating return comes from the non-operating assets and the non-operating liabilities. right? So non-operating liabilities basically most of the non-operating liabilities basically are borrowings, like the current liabilities. I mean current portion of the long-term debt, or simply the long-term debt. So it's basically coming from the financing from the borrowing, and that generates the non-operating assets. So when its return is positive, because when the firm borrows, it needs to pay interest, right, on those debt. So if the return on that borrowing is positive, that simply says that return is higher than the interest rate the firm has to pay. So we just look for the answer which tries to match that implication. You can see that RNOA implies that target equity has grown faster than its NOA. No, there's no such implication, and implies that target has taken on too much financial leverage. We don't know that yet, right? This is not a finance application. I mean, the analysis of the credit risk. And that basically can answer this question, whether the firms takes on too much financial leverage. This is a profitability analysis. So C implies that target is able to borrow money to fund operating assets that yield a return greater than its cost of debt. The excess accrues to the benefit of target stockholders. This is basically what we are looking for, right? We should choose this one. And finally, implies that target has increased its financial leverage during the period. We don't know. Yeah, we need to compare whether financial leverage has increased or not. So only this part is right. So now let's check our answer. Okay, looks like we have got everything right.